If you ask anyone to name a famous stock market investor, there's usually only one person that comes to mind. That person is, of course, Tim Sykes, millionaire, mentor, and trader. I'm just joking, of course, but I swear, anytime I see his ad, I always laugh because his title is Millionaire Mentor first, and then a trader. Because let's face it, all these stock market gurus, they make money by selling courses on how to make money. And I don't have any courses or seminars or training to sell, but all I ask for you in return is to smash the like button and to subscribe. We're getting close to 300 subscribers, so, help me get there. So, going back to the question, picture a successful investor and you'll most likely be thinking of Warren Buffett, the chairman and CEO of Berkshire Hathaway, who is currently worth $80.5 billion and is considered one of the most successful investors in the world. And despite his enormous wealth, Warren Buffett, he's pretty well known for his humble, friendly persona, as well as for being very frugal. The most famous frugal thing that I've read is how he decides on what to eat for breakfast on his way to work.
Good morning. Thank you for choosing McDonald's. Go ahead and order whenever you're ready.
I'll have a sausage McMuffin with egg and cheese.
Anything else?
That's it. Thank you. And I tell my wife, as I shave in the morning, I say either 261, 295, or 317. And she puts that amount in a little cup by me here, and that determines which of three breakfasts I get. 317 is a bacon, egg, and cheese biscuit. But the market's down this morning, so I think I'll pass up the 317 and go with the 295.
I don't know about you, but if I was worth $80.5 billion, I'll probably die young because I'll be going to Five Guys or having steaks for breakfast. But, McDonald's breakfast menu is pretty lit too. In any case, I'm sure we all have our own reasons for admiring Warren Buffett, but for me specifically, I like him because he makes investing more approachable with his, countless quotes and life advices on how to manage money and things like that. You've probably seen them while scrolling on your phone through Instagram or Facebook, like this quote, "Only buy something that you'll be perfectly happy to hold if the market's shut down for 10 years. And also this one, "It takes 20 years to build a reputation and 5 minutes to ruin it." But I want to talk about this advice that he gave. For most people, the best thing to do is to own the S&P 500 index fund. And I want to specifically talk about why Warren Buffett is dead wrong and how buying an S&P 500 index fund is a terrible investment. By the way, please don't. I can already hear fingers hovering to dislike and unsubscribe, but just watch till the end and you can dislike and unsubscribe if you still think I'm full of it. First off, let me start off by saying that investing in an S&P 500 ETF like VOO is a great way to build wealth and it's always better than not investing at all. But the issue I have with his statement is more to do with him saying that it's the best thing for most people, basically dumbing down our ability to, pick and choose investments that will outperform the market. And here are three main reasons people usually give when they say just invest in the S&P 500 index fund. And I'll be using VOO, Vanguard's S&P 500 ETF, specifically because I'm a fan of Vanguard. The first reason they give is that you get instant diversification since you're holding the 500 biggest companies listed in the United States Stock Exchange. And number two, it doesn't require you to be an expert and pore over individual companies' financial statements or anything like that. And finally, number three, they talk about the expense ratio, which is the fee that you pay to hold that ETF, and how it's super low at just 0.03%, where, for example, every $100 you invest, the fee comes to only 3 cents. So let's go over each of the points, starting off with that big fat benefit of diversification. If we go to Vanguard's website and look up VOO, we find that just by owning this one ETF, you get instant diversification because you're essentially holding 509 individual companies. Which is great because when you're properly diversified, you reduce your overall volatility in your portfolio. And if you look right here, you're basically owning shares of all 11 sectors from communication services to utilities. But here's the issue. VOO doesn't hold all these 11 sectors equally, and it's currently leaning very heavily towards information technology at 28.7%. Information technology holds companies like Apple, Microsoft, Nvidia, and PayPal. And this is great when the stock market is doing well and we see Apple and other companies, reaching record high market cap valuations, and technology stocks seems to be going up and up every day. But the risk comes when the stock market turns red and starts crashing. Recently, from September 2nd to September 23rd, the sentiment on Wall Street has changed, and VOO and the overall stock market, it went down 9.45%, almost hitting correction territory of 10%. And during the same period, here's how much Apple, Microsoft, Nvidia, and PayPal went down. Apple went down 18.48%, Microsoft went down 13.41%, Nvidia went down 15.49%, and PayPal went down 13.86%, which is an average of 15.31% compared to VOO's 9.45% decline. And what's worse, let's say only the tech sector crashes 20%, and because VOO is leaning heavily towards tech once again at 28.7%, it's going to experience a 5.76% drop. Compared to if, for example, real estate, which is just 2.6% of VOO, if real estate crashes 20%, it only drops VOO 0.52%. These are, of course, hardcore examples, but you get the idea. People choose to invest in index funds like VOO because they think they're going to be diversified and they won't experience the crazy up and down of the market. But as this pandemic has shown us, tech stocks are the big reasons for the rally that we're going through since March. According to this Forbes article, US tech stocks are now worth more than $9 trillion, with the 5 biggest companies, which is Apple, Microsoft, Amazon, Alphabet, and Facebook, they account for 23.8% of the S&P 500. And out of all 11 sectors that VOO is invested in, information technology is going to be the fastest growing sector, and tech stocks in general, they're going to most likely outpace other industries like financials, real estate, and utilities. If this continues, VOO's technology holdings is going to keep growing from its current holding of 28.7%, which is going to lead to more market volatility, leading to more emotional trading, which will lead to more losses, which will return and lead to more market volatility. So, we've basically seen that VOO doesn't provide proper diversification. So the question becomes, what can you do about it? You can always, pick individual stocks and try to create a more diversified portfolio by owning some tech stocks, some consumer staple stocks, and some dividend stocks. But this leads to the second issue and why people recommend index funds and VOO specifically. It doesn't require you to be an expert and pore over individual companies' financial statements. Because, let's face it, most people are too busy or too lazy to do their own research into each individual companies. So people take the lazy way out and just buy everything and invest in S&P 500 index fund and VOO. Here's a better idea though. I'm going to tell you an easy way for you to have more control of what you invest in, and it'll also give you a better market return than a boring S&P 500 index fund, and you'll get true diversification. This method is going to be a nice middle ground between choosing individual stocks and buying everything, and the best part, anyone can do it. All you have to do is go to Vanguard's website and go to their ETF list and invest in the ETFs that are under sector and specialty ETFs. This becomes such a simple way to choose your investments because instead of looking at thousands and thousands of individual stocks, you're going to choose between 11 different choices. If you want to invest in technology but you're not sure that you're going to be able to pick out the next Apple, that's fine. Buy all the tech stocks by investing in VGT. If you're looking for more stable blue chip companies like Procter & Gamble or Walmart, choose VDC to buy all the consumer staple stocks. If you enjoy using YouTube, Facebook, Netflix, or going to Disneyland, you can invest in all 4 companies by buying VOX. And how about stocks that pay dividends? You can buy VYM that has a dividend yield of 2.52% and it holds dividend aristocrats like Johnson & Johnson and Coca-Cola. Same goes with industries or companies that you want to avoid. If you don't want to invest in oil companies like Exxon or Chevron, you can't really do that with VOO because it holds 2.3% in energy. Instead, you can go back to the sector and specialty list and, just avoid VDE, which is Vanguard's energy ETF. So don't let anyone tell you that, investing is difficult or you need to be super smart to be successful at it. You can follow Warren Buffett's advice and all you have to do is buy sectors you'll be happy to hold even if the market closed for 10 years. If you think information technology is going to be the dominant sector in 10 years, invest in that. And by buying the kind of industries and the kind of investments and stocks you want, you'll be able to create a portfolio that is more tailor-made and that'll provide better diversification based on your risk tolerance. And it'll be much better than you spending your money and just buying a S&P 500 index fund. And plus, depending on what you pick and the ratio and the percentage, you can definitely outperform the market by picking high growth sectors like technology, ETF, or healthcare. Or you can, create a more dividend and income generating portfolio by choosing dividend ETFs and real estates. The final reason that I want to touch upon as to why people recommend VOO is because you'll be paying the lowest expense ratio around. Other ETFs, you'll be paying way more, but with VOO, you pay 3 cents for every $100 you invest. On the flip side, let's talk about VGT, which is Vanguard's Information Technology ETF. This one has an expense ratio of 0.1%, which is more than 3 times that compared to VOO. If you just look at the expense ratio, you might think, hey, VOO is better because the expense ratio is much lower. But you have to remember that expense ratios are just a small part and it should only be a small reason as to why you pick a certain investment. Because if you look at the 5-year return for both index funds, VOO and VGT, VOO has gone up 72.11% or 14.42% per year, which is a great return. Plus, once again, you're only paying 0.03% in fees. But check this out. Look at VGT's 5-year performance. It's gone up 206.62% or 41.33% per year. That's almost triple that compared to VOO. So let me ask you, when looking just at the market returns, would you rather own VGT and pay a bit more in fees? Or would you rather, stick with VOO with the lowest expense ratio? I don't know about you, but I'm trying to grow my portfolio as quickly as possible, and I want to eat Five Guys and steak for breakfast every day. And that's exactly what I'm doing with my Roth IRA number 2 account with M1 Finance. In this account specifically, I have 50% individual stocks and 50% in ETFs. And no, I don't own any VOOs. And in a future video, I'm going to be revealing my holdings in my Roth IRA number 2 account. So make sure to subscribe to be notified when that video is released. And there you have it. This has been my explanation as to why Warren Buffett is wrong, specifically on that advice he gave, and why you should think about avoiding just buying into a S&P 500 index fund. But, take my advice with a grain of salt because while Warren Buffett, he's worth $80.5 billion, I'm only worth $23,100.29. That's all I got for you today. And if you made it this far, don't forget to like and subscribe to be notified of future uploads, and leave a comment below on your thoughts of index fund investing and whether you own any VOOs or ETFs like that. As always, if you're looking to start your investment journey and don't know where to invest, check out M1 Finance and make sure to use my referral links in the description to get free $10 when you sign up and fund your free account. Thank you so much for stopping by. Happy investing. As always, I'll catch you next time with more shenanigans.